Before we get started today, I just want to reset a little bit of our thinking about investing. Up to this point, in this course and certainly in most other finance courses, we have been asking some basic questions. Is this a good stock? Is the company undervalued? Is this bond risky? So this chapter changes the question entirely. From this point, we're going to be asking, how does this investment behave inside a portfolio? So that shift from analysis to portfolio thinking is one of the most important leaps, if you will, in financial education and practice. So by the end of today, hopefully, this lecture, we're going to talk about risk. We're going to talk about risk aversion. We're going to talk about what it actually means when we measure it. We're going to talk about returns and portfolios. We're going to combine all of these, ultimately driving towards a theory, a strategy, if you will, of how we should measure risk and return for assets so that we can manipulate them inside portfolios. So we're going to talk about some statistics. We're going to go through several different ways of calculating individual statistics. Most of these come from a general basic statistics course. We're going to try to analyze what happens when we add securities to portfolios. How does this thing called diversification, how does it come about? We're also then going to review the choices we make when we've gathered this data. We want to try to visualize ultimately what does the risk-return relationship look like when we're dealing with portfolios. So portfolios and portfolio creation are more than just picking good investments. The relationships between the assets, that is the correlation, is important. There is a strategy to combine and manage asset classes. So there are four basic assumptions that we're going to be working with. First, we're going to seek to maximize returns for given levels of risk. It says that returns are important, but risk always matters. Second, a portfolio includes all assets and liabilities. So when we talk about a portfolio, we're not just talking about your retirement account. It's your job, it's your student loans. Sitting in a classroom right now, you are actually making an investment in your future. Third, and this is very, very important, there is a relationship between asset returns, right? It matters. So two risky assets together can be less risky than either one alone. Diversification is a real thing. Finally, a good portfolio is not just simply a collection of good investments. You can hold only great companies and still build a bad portfolio if they all move together. So let's think about risk for a second. Investors should want to minimize risk. There's something called a mean variance hypothesis that says we can choose between two assets just by knowing the expected return and standard deviation. But we do desire lower risk. So risk aversion means that given two assets with the same expected return, we would prefer the one with the lower risk. We see evidence of risk aversion everywhere. People buy insurance. Corporate bonds have higher yields for higher default risk. Stocks earn higher returns than bonds. But risk aversion is not absolute. People are often willing to risk small amounts of money, but they insure against large losses. So this behavior explains why portfolios exist. If investors were not risk averse, diversification would be unnecessary. Harry Markowitz fundamentally changed finance by making one simple and powerful claim. Risk must be evaluated at the portfolio level, not the individual security level. His model assumes each investment has some predicted potential. Investors want to maximize utility. We'll talk about utility later in another video. But this video has diminishing marginal utility. As utility grows, its continuing benefit grows at a diminishing level, if you will. We can estimate portfolio risk. The mean variance hypothesis is the process we use. For given levels of risk, we prefer higher returns. So, what this means is, in other words, investors are not obsessed with beating the market. They are obsessed with efficient trade offs between risk and return. This idea is the backbone of modern portfolio theory. So, using these assumptions, a single asset or a portfolio of assets is efficient if no other asset or portfolio of assets offers a higher expected return with the same or lower risk, or lower risk with the same or higher expected return. So there are several ways we can address risk. We've talked about standard deviation, and that's certainly important to try to understand risk when we're talking about individual securities. But there are other measures. There is something referred to as the range of returns. Quite simply, this is just the highest return minus the lowest return. But there are other measures, and these two are three: standard deviation, range of returns, and something called semivariance. Those aren't the only three. There are others. But semivariance looks at it a little bit differently. It looks at the data from standard deviation, but it only takes into account those returns that are below the expected return. So it focuses on bad outcomes. Again, standard deviation is going to remain dominant because it's convenient. It integrates cleanly into a lot of portfolio management models, and it also works well for diversified portfolios. So let's take a look at some examples of some math here, some calculations, if you will. Everybody loves calculations. So we're using the standalone risk worksheet. You have the workbook from the portfolio management workbook. Again, one of the things you can do here, if you want to do this on your own, you need to set up a table such as this, and then here's the formula for expected returns. So it's a straightforward concept. We've talked about this formula many times for a single asset. This is where diversification, though, begins to matter. A portfolio's expected return is just a weighted average, but its risk is not. We can calculate the beta and returns. We'll talk about beta later. Concentrating on returns right now, we can calculate beta for a returns for a portfolio. So again, here's another worksheet. Again, note the Excel formula that utilizes the weights or the values that are invested in assets and the rates of returns. to calculate the returns of a portfolio. Standard deviation and variance, again, are very important concepts. We want to be able to measure these. We can do it in a long form kind of a formula. Of course, we can also utilize this in a the standalone worksheet. Here is our formula. Some products, it's weight minus the returns minus 1. That's the formula for variance. And of course, standard deviation is just the square root of that. As we know, standard deviation measures how widely returns fluctuate around the mean. So higher standard deviation means greater uncertainty, greater risk. This works quite well for individuals, but it doesn't tell the full story until we get to portfolios. So once assets are combined, again, correlations start to dominate the risk of outcomes. So the statistics we want to build on here first is covariance. Now, we don't really use covariance in any formulas or models. But covariance gets us to the next statistics. So covariance is just a measure of the degree of how two assets move together relative to their individual mean values. So we see our formula here, covariance dot S, because we're using a sample. If you see here, I have 12 months of data for the S&P 500 and for the Barclay Bond Fund Index. So the arrays are the columns of numbers. So you would equals covariance dot S parenthesis, highlight this set of this array of returns for S&P 500 and this for Barclays. And then obviously that gives us a formula. We can also do this in Excel with Excel's data link that's an add-in into the Excel function. We can calculate again and get this table where in this case you see, if I can make it a little bigger, these are the covariances. So the covariance between the S&P 500 and Barclays is 0.43. Now the challenge with covariance is it really doesn't tell us anything about power. How powerful is this relationship? That's why we utilize something called correlation. The correlation, if you notice, uses covariance, and then you divide it by the risk, standard deviation of the product of the two assets. Again, here's our Excel formula. This is the output that we get from doing this in Excel with the data function. So correlation standardizes this covariance. It'll be between -1 and +1. This is the engine that drives diversification. Two volatile assets can produce a low-risk portfolio if their returns are not perfectly or are imperfectly correlated. So in this case, we have a very low correlation. Combining these two assets should provide some substantial opportunity for diversification. That's the end of this video. Look forward to seeing you in the next one.